Okay, good morning, everyone, and welcome to what is now the 46th edition of the Coffee Microcaps morning meeting. For anybody who is joining us for the first time, my name is Mark Tobin. I'm the founder of Coffee Microcaps. We're just going to go through a couple of quick housekeeping slides, and then we're going to get straight into it with our first presenters. Quick compliance and disclaimer slide. For anybody who's joining us for the first time, and the companies we generally have on here every week are under 300 million market capitalization, in revenue, or approaching cash flow break even, and indeed some which are already profitable. We generally don't have companies from the resources or the biotech sectors, mainly because they don't meet that revenue criteria from the previous point. So we look at what we kind of call industrial microcaps. So that's microcap technology names, microcap healthcare, microcap industrial services or industrial products businesses. And it's really kind of a catch-all term for anything outside resources and biotech. Structure of this morning's webinar, we're going to have two companies presenting over the next hour. We used to run these every fortnight. More recently, it's been every week. Each company is going to be on for 30 minutes, broken down into a 20-minute preso and 10 minutes of Q&A. If you do have any questions, please type them in the Q&A box rather than the chat box. It just makes it easier for me to moderate the questions to our presenters at the end. Please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow morning. And if you want to follow Coffee Microcaps, you can get us on Twitter at @CMicrocaps, YouTube for the recording of this webinar and indeed all the previous webinars, LinkedIn, and I also write a weekly paid subscription newsletter where I profile one interesting microcap stock every week, and you can get that on the Substack newsletter platform. So up first, we're going to hand over in 1 minute now to John Kelly, CEO, and Will Souter, CFO of Atomo Diagnostics, and then we're going to cross over to Perth and we'll have Dan Madden joining us from Joyce Corp. So without further ado, I'm going to stop sharing my screen and then I'm going to hand over to John, who's waiting patiently.
Good morning, everyone. Can you all see the...
We can, John, if you just want to put it into...
Lovely.
There you go. Perfect.
All right. Well, thanks, everyone, for this opportunity to talk. Atomo Diagnostic is an innovative Australian headquartered medical device company focused on the diagnostics market. We're Australian headquartered and listed on the ASX. We listed in April of last year, but our global operations see us manufacture our products offshore, and the vast majority of our customers and revenue base is international. And up until about 8 weeks ago, before the COVID outbreak developed in Australia, nearly all of our revenue was through international supply agreements, but we are seeing very strong growth here locally now with COVID. Our technology is increasingly recognized globally as best in class, disruptive, and a market leader. And we're very excited about the opportunities now for the business, not just for COVID, but beyond COVID, as point of care testing becomes much more mainstream in terms of supporting healthcare. We're in revenue, we're growing rapidly, and our CFO will talk a little bit about our financials in a subsequent slide. In terms of our financial highlights and key deliverables for FY21, we managed to get our rapid antibody and antigen tests listed on the ARTG here in Australia. We sold about 50,000 tests in the second half of the financial year. They were mainly antibody tests. We did very few antigen tests through to 30 June, but we have seen a very significant step up in demand in FY22. Outside of Australia, we secured an agreement to supply up to 2 million devices to our partner in the US market for their rapid antibody test, and that test received FDA approval at the very end of FY21, late in June, and as well as opening up that contract, it's also the first FDA approval for our platform and has really supported and underpinned a number of discussions with other interested US partners for accessing the platform. Outside of COVID, we have what we consider to be the world's best HIV self-test. It's one of only 4 that's ever been pre-qualified by the World Health Organization, and one of only 2 that was selected for a large UNAID program in global health covering more than 100 countries. We supply that exclusively through our partner Mylan, now Viatris, a large listed pharma company that sell a lot of HIV drug medicines into those channels. And that was our flagship product that we took to market a couple of years ago. Outside of HIV and COVID, our devices are increasingly being used in other diagnostic applications, and we have a growing list of OEM customers that we supply our devices to, and they put their own test chemistries in there and launch their own products. And that's given us the ability to scale outside of our core business. To support ongoing growth, we're looking to now actively pivot into the US market. That's a market where most of our customers are based, most of our inbound inquiries are coming from, and the large growth of point of care testing has been centered in the US market, and that's where we see our future. We have developed the world's best rapid blood tests for integrated point of care testing. We're now looking to expand our addressable market, and we're working actively to bring equally innovative and disruptive solutions to swab and saliva-based testing. That allows us to expand our business and also better support larger customers who have tests across different sample types. These were our deliverables to the market last year. In our results at the end of FY20, we set up our goals for this FY. We did have a couple of deliverables that came later in the year than we had hoped for, largely out of our control. One was a US FDA approval. The other was the winning of this UNAID global supply tender. Although they were late, they were delivered, and they do set us up very well for FY22. I think the main point here is we've substantively delivered on what we said we wanted to do. Our capacity has more than quadrupled. Our US market entry is on track, and we're now developing new platforms. And I think we're very well positioned for growth in FY22 and beyond. Our COVID business has been growing dramatically over the last period. We sold over 1 million devices to partners for OEM supply into COVID testing, as well as selling, as I mentioned, 50,000 units locally in the Australian market. We had very little COVID antigen business up to 30 June. We supplied about 5,000 or 6,000 tests to a number of the Australian Olympic teams as they were preparing for and going through the Olympic program. But it's really only in the last 6 weeks that we've seen a very significant step up in demand for our antigen products. Minister Hunt is now talking about an expansion of rapid testing in the market. We're seeing a lot of inbound inquiry from a whole range of corporates, aged care, industrials, travel, mining, and increasingly public sector groups, a lot of interest from schools. So really, we think antigen testing is growing rapidly. It's here to stay. Australia's playing catch up with other markets where rapid antigen testing is one of the main pillars of managing a return to normality, in the same way that masks and QR codes are. We're selling more antigen tests each month than we did in the whole of last FY. We're looking to move into the self-test space, subject to TGA approval, and that would then further expand that market. If we look to the overseas markets as a guide to what might happen here, we know that in places with high levels of vaccine efficacy, Israel and the UK, they're doing more rapid testing now than they were during lockdown. And I think, that speaks to the fact that as people get out of the house and move more about their daily business, testing becomes more and more a tool to manage risk. And we expect to see testing ongoing over the medium term. Our HIV business was steady last year. It was delayed in terms of revenue scale up because we didn't see that tender until April. We did see the first orders coming off the back of that tender. We delivered the first small batch just prior to 30 June, but really we'll see that growth come through in the next couple of quarters. The global test market's expected to more than double over the next 3 to 5 years. And we're one of only 2 or 3 products really qualified and capable of servicing that market. So we see that as a steady growth opportunity for the business. Interesting to note that we've been successful in launching our HIV self-test here. It's the only infectious disease self-test that the TGA have approved for the local market, and it puts us in a very good position with a monopoly, not only for HIV self-testing, but to be one of the products of interest, we think, in terms of self-testing for COVID as well. We haven't to date secured commercial agreements for two very large markets for HIV, being the US and China, and we're working to try to bring to market in this FY22 a commercial arrangement that would see our product brought to both of those large markets. So we think overall we're in a very good position to see sustained growth in our HIV business over the next 3 to 5 years. Outside of those two flagship products, we have a platform that's increasingly recognized as delivering unmatched usability. And that really opens up a whole range of applications, particularly as the market now post-pandemic in the US starts to move to telehealth and home health. Not really a channel at the moment in Australia, still very much a pathology-driven market here. But in the US, the market's been significantly disrupted by the pandemic, and home testing now accounts for a much more attractive opportunity for some of the larger players. And we're starting to see inbound inquiry from some bigger companies now looking to evaluate the technology. We had some early adopters onto the platform pre-pandemic. Lumos, who came to market recently on the ASX, use our platform for their Febridex test going through an FDA submission. NG Biotech in France, Access Bio in the US. And these companies have allowed our technology to be seen in the market, to get regulatory approval, to generate some market traction. And we're now seeing inbound inquiry from a number of larger companies looking to try and see whether our technology could scale across some of their product lines.
So the chart on the top right just highlights where Atomo has come from over the last few years. The first 8 or 9 years of the business were very much focused on R&D and developing these best-in-class platforms, getting regulatory approvals for those, protecting them with patents, and really streamlining the process to build and distribute them into competitive global health markets. So FY18 and 19 were the beginnings of commercialization, with the sale of our HIV test starting in South Africa as an example of how the test could be used in all sorts of markets. And then really it was only in FY20 when we started to roll out the contract with Viatris for supply into LMIC markets of our HIV tests. And then the tail end of 20 is when obviously the COVID business started to kick off. So of the 5.4 million in FY20, about 3.4 was COVID-related sales, particularly to NG Biotech in Europe for their antibody test on our platform. And then that momentum rolled into the first half of FY21. We continued to supply NG Biotech. We did make some deliveries to Access Bio in the US in anticipation of their FDA approval, but as John said, that didn't come through until the very end of the financial year. And also the HIV tender was delayed. So those couple of key milestones came late in the year, but notwithstanding that, we still managed to grow revenue by 25% to 6.7 million and keep our gross margins in our target range of 50 to 60%. In terms of the balance sheet, we consumed some cash through the year. We raised $30 million at IPO last year, just by way of reminder, and paid off some debt we had with the Global Health Investment Fund, around $7 million. So we came into the year with a clean balance sheet and a mandate from shareholders to invest that in expanding the business, both on the revenue side, but also on the production side. So as John mentioned, we've significantly ramped up our capacity throughout the year, taking it from around 300,000 units production per month up to 1.3 million units of production per month. And also continue to invest in R&D, in particular optimizing and expanding our range of devices, and also investing in our proprietary blister machine. We've redesigned and started to build our second one of those, which is a very significant part of the IP of the business that produces one of the key components of blister that goes into the Pascal and Elion platforms and enables the final step in the process of fully integrating rapid test into one device. Just a quick summary of the cash flow activities. We collected over $8 million in receipts from customers, a little over $1 million in R&D rebate funding, and another little over $1 million in option conversion funding. and those cash outflows, as I've just described, as well as obviously growing our working capital position to support top line growth, and also investing in our capacity in South Africa, where we produce our HIV test in anticipation of supplying into the Unitaid tender. So a good year of cash collections, but also investment, and that sees us at the end of the year with around $18 million of cash on hand, and as I say, no debt.
In terms of our story, I think it reflects what Will was saying. Really, from 2010 to 16 was R&D and usability and clinical development work. We secured some global health funding in 2016 to launch our HIV self-test into the South African private sector. We're still the leading test there in the private sector, and through that we were able to secure an agreement with Mylan, now Viatris, for scale up globally. And off the back of that validation of the technology, enter into a number of OEM agreements. So it's really only through 19 into 20 that we've kind of pivoted into the commercial scale up. The pandemic disrupted that, but at the same time provided an opportunity for COVID that we've been able to now execute on. And for us, market entry into the US now becomes the next major step forward in terms of the growth and development of the business. We're very excited about the opportunities for the technology in that market. This was kind of the technology before Atomo came along. Rapid test kits, bit of a year 12 chemistry set. These assays were developed for use in labs originally 20 years ago, when the lab machine wasn't working. You could run a rapid test sort of in off periods. Then that moved into the wards, clinics, doctors' offices, and more recently into pharmacy and home settings. But the usability of these kits was never really designed for point of care deployment. It's a bit of an afterthought to throw a box of accessories together. And the usability is very poor. User satisfaction's low, error rates are high, and regulators don't really like the complexity. And as a result, home testing's not really been that well capitalized on, and the opportunities in home testing haven't really been delivered because of these challenges. Atomo's premise was pretty simple. The science works very well. The chemistry on the strip works very well. It's the deployment to the end user that really lets the product down. So we decided to essentially develop from the ground up a consumer-friendly device that would allow a user to test reliably, test conveniently, and deliver a much better outcome for the end user, but using the same test strip that was in this bit. And we've done that very successfully. We've developed the world's first integrated all-in-one rapid blood test devices, and it simplifies steps of use. It reduces out errors. We've got over 95% user satisfaction compared to the bits in box format. And the analogy that I use is, essentially everyone's been watching movies on black and white. We've come along and we've brought color TV to the market. And yes, you can still watch the movie on black and white, but once you've seen it on color, the black and white looks a bit agricultural. And I think that's really what we've done here. We've disrupted the market with a next generation solution. It's a solution that's very flexible. We can drop any number of blood-based strips in there, and we've proven that now across multiple applications. And we're looking to now expand beyond blood into saliva and swab. And ultimately, our goal is to have this technology make those chemistry set kits obsolete. And to do that, we need to now partner with one of the larger companies that can affect a level of scale across the industry that we're going to struggle to do organically. And that's now the second phase of our strategy. We've got the regulatory credentials now to support those conversations. TGA, US FDA, CE Mark, one of the very few number of products that's got WHO pre-qualification. I think for a small company to deliver this level of regulatory validations, impressive, and it's worked very favorably towards us having discussions with larger groups that want to utilize our technology. We also were the first company that really tried to integrate a test kit into a single device, and we got some high-level patent protection. We don't really care about the diagnostic that sits inside it. Our IP relates to our ability to integrate and simplify a rapid test into a number of easy-to-do steps. We've got some patent families that cover that, we think, very robustly, and we've also gone to the trouble of patenting in a lot of markets. So as well as the usual North America, Europe, and Japan, we've also got IP in any market with a sizable population. So our patents are granted in Brazil, China, India, Russia, Indonesia, and that helps us scale up across global health markets as well as in developed markets. Behind that, we also have a lot of proprietary know-how around how to make this device work. We've developed our own manufacturing processes that are state-of-the-art, and we really do have a product that's extremely difficult to reverse engineer and bring to market. And the larger companies are, I think, realizing that it's much easier to license technology from us than try to spend 10 years and $100 million to get there. Our operations, as we'll mention, have been scaled up over the last 15 months. We have outsourced manufacturing in China for the device. We have our proprietary blister machine running in a facility in the US. We have a second generation blister machine currently being validated here in Sydney. And our HIV operation in South Africa is now certified by the TGA and World Health. We can scale that as needed. We've got capacity to do 25 million per annum. We can scale that to 50 if demand requires it, or we can start to look at tech transfer and licensing arrangements to other diagnostic companies that can manufacture on our behalf. And there are a number of opportunities for us to look to do that if we choose to. The products themselves are best in class. Our user feedback's unmatched, and our products really do matter, and we're very proud of that. This is really, I think, one of the most important slides in the deck. It really talks to the disruptive nature of the pandemic. In the US, telehealth-based medical consults were 0.2% of the market pre-pandemic. At the peak of the pandemic, they were 16% of all consults, and now it's stabilized at 6 to 7% of all consults. That equates to tens of millions of home-based consults every year. And on top of that, you now have the emerging e-health and telehealth market through companies like Roe and Everlywell, who are really disrupting the doctor office and pharmacy markets with a direct-to-consumer model. And those models require easy-to-use tests. And Atomo's got a platform that's well recognized as a leader in that segment. That's now starting to get the attraction of some of the larger diagnostics healthcare companies that were previously in the lab and doctor office business. They're now seeing rapid testing and home testing as being a growing segment. And we think that allows our technology to really be revalued in that US market. And what that does then, I think, is prioritize for us some key things for this coming year, secure that US market entry partner, continue to maximize revenues for COVID here in Australia, and supporting our HIV business over the longer term with the Atris, bringing new OEM customers to the platform now that we've got extra capacity to support new customers, continuing and completing development of non-blood products, so that would be saliva and swab applications on our platform, and setting up and executing our US market entry strategy. And if we can do all of that in the next 12 months, we'll be in a very good position, we believe, to move forward. And that is the presentation. Happy to take any questions.
Thanks, John. We've got a few that have come in already, so I'm just going to jump straight into them. I haven't had a chance to read the Australian myself this morning. I'm not sure if you had. As per the Australian article today, if you needed to bring up to 1 million antigen tests per week, selling at $10 to $12 a test, are these manufactured by Access Biopartner? And what's the margin on these volumes?
Yeah, so the 1 million per week is the volume that Access Bio can provide to us for the antigen test. So the antigen test that we sell in Australia is bought back from them. It's not on our platform. So that sits outside of our 20 million a year capacity that we just discussed. So we don't have any capacity constraints on bringing in antigen product. And that gives us the ability to scale up in the Australian market as we need to through this pandemic. The margins, we don't disclose individual product margins, but the margins are in keeping with our target of sort of 50% as a blended average for the business.
Okay, great. Then can you explain the goals of the Melbourne private hospital home self-test pilot you've underway? And do you feel it's significant enough to sway government opinion on rapid antigen testing adoption?
Yeah, it's a good question. I think government opinion on rapid antigen testing has already changed. Minister Hunt and Gladys Berejiklian have both mentioned the need to move to increase levels of testing. The TGA have indicated that they are now looking to assess home test options for antigen testing. The product that we source from the US already has been awarded a self-test approval by the FDA. So there is obviously all of that US self-test data available as part of a submission to TGA, but we felt that it would be really helpful to have some local Australian usability and acceptability data. So we're looking to do a smaller study here to augment the data that we have from the US evaluations.
And then the next one, about the saliva product. When is this likely to be completed and approved, and how does it compare to the Illum COVID-19 home test currently, it says, sold out in Queensland?
Yeah, so the saliva platform, we think's probably got another 9 to 12 months of development to get to a point where we can commercialize an assay on it. We haven't yet decided what actual chemistry we're going to bring to market on that platform. It may not be COVID. We're looking at a couple of other opportunities for home testing in some areas that we think are underserved and provide us with a really unique position to come in as a market leader in an unmet channel, rather than try to compete in the COVID market that within 12 months time will possibly be sort of commoditized. So we're very excited about the platform, but not necessarily saying it's going to be a COVID product on that platform. I think there are other opportunities where we could be in the market with a completely unique unmet product that offers real market share.
Okay, great. And I haven't had a chance to go to the very back of the annual report, but how is the share register looking these days since you've been listed now for the best part of nearly 2 years now? Has it changed much from IPO, or where does it sit currently?
Yeah, I'm happy to take that one, Mark. I mean, I think, look, we've gone through quite a difficult journey in terms of funding the company pre-IPO with individual seed money early on, and then some really strong supporters from credible players like the Global Health Investment Fund, who came in a couple of years before the IPO, and then high-profile investors like Lang Walker and Alan Moss. As we progressed through pre-IPO, we did a pre-IPO converting note round. And when we came to the market, obviously there were quite a lot of people there that were well in the money. And so over the course of the last year, some of those have come out of escrow and have moved on. And I think the volumes over the last little week or two will give people an indication that some of that selling is now done and dusted. And we were very pleased to see SG Hiscock go substantial this week. They've got obviously a small cap focus, but also a particular focus on medical technology funds. So I think the overall register is in really great shape now, with some strong institutions involved, as well as the Global Health Investment Fund still sitting there, and then a number of savvy high net worth individuals and individual and retail shareholders as well. So the register is really in great shape at the moment.
Okay, great. Another one, John, in regards to ESG, can the test kit be recycled?
No, the test kit can't be recycled. It's a single-use disposable product, and obviously has biological waste on it from the use of the test. So it's not feasible to recycle. We obviously do, as an impact-focused company, take our ESG very seriously. We deliver products at reduced margins into developing markets, and we've got a commitment to the Global Health Fund to continue to do that. We also manufacture in South Africa our HIV product, and we're an ethical employer. So I think we do have a good ESG mandate, but the products themselves are single-use, non-recyclable, and that's the nature of these types of products.
And then final one, if we can just squeeze it in the last minute or so, with many rapid antigen test competitors in the Aussie market, do you feel once TGA allows home testing that the product price will come down heavily?
I don't believe so. I don't think that every product that's listed on the ARTG for professional use will translate into a self-test. I think the TGA, I can't speak for what they're looking for, but I do know that to deliver a self-test product in Australia, we've got some experience through our HIV product. You need to have 24/7 product support line, onshore validated distribution and product traceability and recall capabilities, clinical and regulatory support. I don't believe most of the small private importers and resellers can deliver that level of functionality to support the product. So I do suspect that there'll be a smaller pool of products approved for self-test, and I think we're hopeful that we're one of those. And I think self-testing also doesn't have the overheads of clinical deployment, which means that it's more cost effective. So I think the pricing can still be very attractive in that channel, particularly if you're selling direct to consumers through the website. We've got a consumer website already set up. So I think the margins can be maintained in self-test.
Okay, great. John, Will, we're going to have to leave it there. We're just literally up on time now. Thank you very much for joining us this morning. And John, if you could please stop sharing your screen, because I know Dan is patiently waiting for us over in Perth. Dan, if you want to try sharing your screen now.
Thanks very much, Mark. We'll drop off.
Thank you for having us.
Okay, thanks, Will. Thanks, John. And just go to full screen mode, Dan, if you would, please. Yeah, perfect. You're ready to go now, Dan. I think you're still on mute, Dan, if you just want to take yourself off mute there.
How's that?
I can hear you now, Dan. You're ready to go.
Great. Fantastic. Thanks very much, Mark. Thank you very much, all of you, for your interest and for your time. And I hope you're all well and safe wherever you are around Australia and surviving the lockdowns. I'll try and get through this and make sure that we leave some time for some questions at the end. I'm just move through the disclaimer. This presentation is on our website. I've just rearranged some of the timing of it, but it's all on our website from the 31st of August on the ASX as well. So please read the disclaimer at your own time. For those of you that aren't familiar, Joyce is a well-established, long-standing ASX-listed company. We've got two high-quality Australian businesses in KWB and Bedshed within the group, within our portfolio. Our focus is to drive revenue growth and deliver above average returns through capital appreciation and dividends. And I think we're very well positioned to do that and to grow into the future. And I'll explain why as I go through the slides. With regards to our ethos, we think that working together with all stakeholders is the key to success. Whether that's subsidiary or partnership businesses, franchisees, employees, customers, shareholders. And we're very focused on taking an approach of developing strong relationships to make sure that we all prosper in business together. Some of you may have seen this before. It's just to show how the group businesses, the economic engines, if you like, how the flow of the economic interest flows into Joyce shareholders' pockets. On the left-hand side there, you see the businesses that we have within the portfolio. KWB Group, leader in Australia's home renovation market, focused on kitchen and wardrobe solutions in the do-it-for-me market. We have a 51% majority interest in that business, and the net profit, obviously, from that is attributable to the Joyce shareholders. When you look at our accounts and our results, that's consolidated and recording at 100% basis, and then we back out the minority 49% interest on a single line in there. And I try and make sure that when I focus on the results, I'll talk about KWB's performance in and of itself as an entity, and also when I talk about Joyce, so you can see the net profit attributable to Joyce shareholders, which is obviously the focus. Bedshed, well established, 40 years now in and around Australia. We have a franchise operations, which is the predominant arm of that business, and we have some company-owned stores. So we receive franchise fee income, and we receive 100% results from the company-owned stores. They feed into the Joyce Corporation, listed on the ASX, JYC. We've got $20 million of group cash, and the balance sheet is also supported by the Perth property that's owned 100% by Joyce at circa $5 million. And there's actually an investment property held by KWB, which is circa $10 million. So a strong balance sheet as well within the Joyce entity, and franking credits of $5.5 million. We have a history of paying dividends and a history of paying those dividends fully franked, and we'll be doing the same with the year-end dividend that will be out early next month. So I'll focus now on the operating results. Very, very solid year for us. Strong year with record results across the board. This is just a snapshot of the key results, and then I'll talk about those in a bit more detail. Record revenue of over $100 million, 30% increase on prior year, obviously driven by strong demand for our products and also from the growth in our network. That resulted in a very strong operating cash flow, $27.2 million, 100% increase from the prior year. And as I said, the group net cash sits at $20 million and debt-free. That's converted to Joyce shareholders with a net profit after tax of $7.6 million. Significant increase from prior year, and the earnings per share obviously is reflected in that at 27 cents per share, 71% increase. And that's from the continuing operations, and I'll talk a bit more about the Lloyd's divestment later on, but from like-for-like operations being Bedshed and KWB. And that's led us to a full year frank dividend of 10 cents, which is a full year, dividend, a year-end dividend of 10 cents, full year dividend of 17 cents, 70% increase, record dividend, fully franked, payout ratio of circa 63% of the NPAT. Again, I'll talk a little bit more about that as I go through some of the slides. I'd like to draw your attention to the return of JobKeeper, which we announced actually at the half year end, consistent with our values when it was clear that there was a rebound in performance from that first half of the year. And we returned $1.5 million of JobKeeper earlier this year in terms of this calendar year. So from shareholders' returns, there's been a significant increase in returns to shareholders, both through the capital appreciation and the quantum of the dividends. You can see there over the last year, we've grown from $1.50 to I think circa $3.50 we closed out yesterday, and that was ex-div, I believe. We did hit briefly 364, which in the last couple of weeks, which was 100 million market cap, which was the stated aim of the business, I think a year and a half ago, was within 3 years to hit 100 million market cap. So, that was quite a pleasing milestone to hit, and we're there or thereabouts at the moment. As I say, the dividend there sits at 17 cents, and that compares to 10 cents in the prior year. I think what's important though is to draw your attention to the fact that we've talked about a 60 to 80% payout ratio on normalized NPAT. That's a reflection of how well and consistent the operating businesses are, and how well we believe they are performing and will perform, and the growth that is in those economic engines to the business. We think we're well positioned to deliver a steady increase in dividends over time, and certainly we'll seek to maintain that ratio and look to increase our dividend payment. The key financial performance metrics are here. The profit margins, I'll let you look at that information in your own time. A lot of you probably already have. These are group results at the top half, so 100% results. Revenue there, as I said before, of $111 million, significant increase, but also the contribution margin has increased as well. Group expenses as a percentage of revenue have actually proportionally decreased. So we've had increased contribution margin, increased EBITDA margin, and obviously increases in dollar terms as well. So converting into that $7.6 million NPAT attributable to Joyce members, and that EPS performance there, as I say, on the continuing operations with a 71% growth. With regards to the financial position, as I said before, a strong position with almost $20 million group cash on hand. We had $4.9 million in the prior year. We've retired the debt, so we've got a good balance sheet in terms of being able to draw on that for gearing if need be. The property on the balance sheet as well also underpins the strength of that balance sheet. Importantly, our businesses as a franchise operation and the KWB business model, which those of you who would have heard me talk before would be familiar with, as I ran through that, have low working capital requirements, streamlined operations across the group, and that meant that those results have contributed to a significant increase in the operating cash flow that you can see there, $32 million versus $17 million from the prior year. I'll let you work your way through obviously the cash outflows. They're all pretty standard. Obviously there's a dividends to the minority interest as well, and the 3.4 million increase there was a one-off as we finished the divestment of the Lloyd's business and received the final payment on that divestment. So turning to the performance of the businesses, KWB has a fantastic track record of growth across the board, again on the metrics, revenue, profit, margins, and an expanding footprint. And I'll talk through that at the moment. So for those of you that aren't familiar, KWB operates under the Kitchen Connection, the Wall Span, and the Wardrobe Connection brands. The storefronts are Kitchen Connection and Wall Span. Kitchen Connection on the east coast of Australia and Wall Span are in South Australia. We're a leader in the home renovation market. It's the do-it-for-me delivery from inspiration to installation, as we phrase it. So that's basically the showrooms of the kitchens, the design of the kitchens, and then the managing of the whole process of delivering, installing, selecting your product, and we manage that whole process for the customer. As I said, we're across Australia. I'll show you on this graph here exactly where we sit. The business started now probably around 7 or 8 years ago, focused primarily in Queensland and South Australia. We now have 25 showrooms across Australia, and the recent expansion has been down the east coast from Queensland down into northern New South Wales, Central Coast, and more recently during this financial year we've moved into the Sydney Metro, Sydney regional area. Castle Hill and Atomo were the last 2 stores opened in the last financial year. Atomo's obviously quite close to central Sydney. The stores there have really hit the ground running. There's been strong demand from the offset, well placed in good homemaker centres where we believe there's a good market for that renovation market. So a good customer base. Certainly seeing those results with very strong trading across those new stores into Sydney and also the established stores. We have further showroom expansion in the current financial year. We've got 4 stores expected in this financial year. Penrith actually opened in early July. Belrose is shortly to open, and we're just sort of juggling the timing of that with lockdown restrictions and what have you, and making sure that we bring that to market at the right time. And then we've got 2 other stores, Castle Hill and Atomo, lined up for opening in this year as well. And then further store expansion into 2023. Steady state for us is around 4 showrooms per annum. Beyond New South Wales and down into Victoria, we're just under review with what that longer term strategy might look like. Certainly a very strong market, we think. We see the potential to replicate what we've done in Sydney, and it's just an assessment of how best to enter that market and whether it's at that normal 4 showrooms per annum or maybe a different a different expansion. But that's the focus at the moment is very much on Sydney, and those other questions will get answered in time. So the group results, as I said, very strong results and a strong track record. $89.7 million of revenue on a 100% basis from KWB, compared to $67.5 million in the prior year. This graph at the top here is basically showing the waterfall growth to the last year's revenue. Those FY20 stores that did $67.5 million delivered $82.5 million on a like-for-like basis in FY21. We then opened those 4 new showrooms during the financial year. They delivered $7.3 million of revenue. Those stores, remember, weren't open for the full year, so they will be operating for the full year, notwithstanding lockdown restrictions in the current FY22, plus the new stores that we'll bring into that. So it's a pretty good basis for growth and growth in revenue performance into the next financial year. And a very, very strong year with, as you can see, 14.9 million additional revenue from the existing stores in FY20. What's really pleasing as well is that order book sits at $107 million. So that was the orders that we took in last year. They convert to revenue once we've actually done the full installation. So there's obviously a cycle to designing a kitchen and actually having it installed and delivered and closing out. So $107 million of orders, which was a 44% increase on the prior year. So more of an increase than the revenue. We're obviously operating at capacity last year. That $17.5 million of order book will fall into this current financial year. So that gives us a very strong platform into the current financial year. With regards to the profitability, again, what I'm trying to do here is just show you that growth profile over the last 5 years. If we just focus on last year's, the FY21 EBIT of 16.3 versus 11.3, so a 45% increase in the EBIT, which was more than the revenue of 34%. Margin increase as well that obviously contributed to that. So there's an ongoing focus on the operational and cost efficiencies within this business. John Burke, who's the managing director of KWB, and Chris Palin, who's the finance director, do an absolutely fantastic job with just continually evolving and focusing on the operational and cost efficiencies in this business, as well as the product offering to the customers, as well as that expansion of that footprint. And it's a testament to them that over the last 5 years, we've had 120% revenue growth, $40 million revenue in FY16 when we had 13 stores. We currently sit at 26 when Belrose hits. When we've hit 28 stores, I think we'll be the largest player in Sydney. As that growth has continued over those years in revenue and in footprint, it's continued to deliver an increase in EBIT and an increase in margin. So, very, very solid growth profile and consistent. There's been, a maintenance of the rework level through the business. That's something that is a cost to us and reflects how well that business, efficiently operates. Because if there are errors in the process that we have, whether that's with a delivery, with a design, with the manufacturing, then that's basically a rework cost to us. Our reworks have consistently been around 1%, and that's, I'm pretty sure that's market leading, something that, we're very, very proud of, and is proof of the pudding of how well this business model works for us as a business. With regards to customers, and with one of the success that, that the footprint growth has worked so well, and we've entered Sydney so well. A lot of that's about the referrals and the reviews of the product. We haven't had to do a lot of marketing in the last year as we've gone into Sydney. Being in the right location, word of mouth, and product, reviews have really supported us, and I think we're the only company, in fact we are the only company to receive over 1,500 5-star reviews on Product Review, which is an independent customer review site. So again, there's this proven track record of this business. With regards to Bedshed, very solid performance and good growth. Again, this is a long-established business now, over 40 years in Australia. Very strong brand and loyal customer base. 37 store network, 32 of those are franchisee owned. There are 4 company stores. You can see those and where they're located across Australia on this map. Our focus at the moment is moving into New South Wales. There's been a strategy for that now for the last couple of years. The COVID outbreak interrupted that strategy and the work of the business development manager. But we've established an e-store which is running well. That's really a strategic move to have a presence in New South Wales, to be able to do the marketing, to sell the product. And then that helps, bring the franchisees in, as well as the strength of, the other franchisees within our group, which is obviously a selling point to new franchisees. We've got a pipeline of franchisees, ready and waiting to go in New South Wales. We've got 2 stores that we're going to bring to the market as soon as COVID restrictions are released, and I'm confident that we'll have more than that and other properties lined up for franchisees before the end of the financial year. With regards to the results, on the top here, what you're seeing is the franchisee performance. That's the main focus of the business. You can see there the growth over the last 4 years in EBIT, and particularly draw your attention to margin as we increase the network sales growth and we increase the network footprint. The margin obviously increases quite considerably. It's a low capital intensity business in terms of a franchisee network. Marginal cost to expand, so that's our focus. Very much looking forward to what we can do in Sydney over the next 12 to 18 months. In terms of the actual results of the business and the performance, what you're seeing on the bottom there is the full group revenue for Bedshed, so that includes the company stores. An 18% revenue growth, 27% EBIT margin, blended on both company stores and franchisee operations versus 10% in the prior year. It's certainly useful to have company stores established though, because it shows franchisees, that we really understand the issues that they have, and it helps us with the marketing and the merchandising strategies that we have, which we operate on behalf of the franchisees as well, although we don't hold stock for franchisees. So moving to the end to leave some time for questions. Our focus certainly on the next 12 months is organic growth within those businesses that we have. KWB, as I've already mentioned, a focus over the next 12 to 24 months on Sydney and establishing Sydney. We'll then move these untapped states, Victoria and WA. So there's a lot of growth expansion there with KWB. As I say, it's proven to have taken that growth expansion very well. Capital light business model, so it's not something that will have large draws on our capital. The franchise network expansion is the main focus in Bedshed within Sydney, as I said. Also looking to at opportunities around Australia, and I think we'll see some of those come to fruition in the coming months as well. And a real focus on the online sales and the online marketing that we have in terms of e-commerce and also product management, franchisee management. So that's something that we're continually developing, and actually was developed pre-COVID and really helped us with our e-commerce offering during COVID. From Joyce Corporate, the strong balance sheet underpins our longer term growth opportunities. Low gearing ratio, property assets available for potential sources of funding. So we can do that at low risk without dilution or equity dilution, I should say. There's a consistent focus on minimizing the corporate costs. With regards to the sort of longer term strategy and the growth strategy, As I've said, the organic growth is a near-term focus. KWB is a cornerstone asset for us, that 51% ownership. Where we understand how solid that business and what the growth profile is of that. So, we would look to build on that cornerstone asset, if appropriate. We've got a disciplined approach to looking at future opportunities. For those of you that may be familiar with Joyce in the past, I understand some of the feedback has been, you invested in an online auction business, you've got investment property, are you a small investment conglomerate, or are you actually trying to, focus on that revenue growth from operating businesses? And we're certainly trying to move to that. And that's the remit that we have now. It's looking at, opportunities that are in adjacent sectors, natural fit to the portfolio, the group's portfolio and the group's expertise, and a focus more on opportunities with a pathway to ownership and operating, as opposed to minority interest in a pure investment play or a private equity listed, a listed entity that's effectively operating as private equity. That's not where our focus is. And clearly, with the low capital intensity opportunities that the low capital intensity businesses that we have in the portfolio, we're certainly attracted to opportunities that are consistent with that. So look, at that I'll finish, and I'll basically take any questions. I'll just skip through these appendices and leave on the closing slide, so that you can take those details down for any questions into the future and contact me.
Okay, thanks, Dan. We have a couple of questions in already, so I'll just jump straight into them. Can you provide some background to the 51% stake in KWB, and is there a pathway to full ownership at some point in the future?
Look, that investment was, I think, back in 2013, 2014, a 51% investment into that business. John Burke and Chris Palin, who, as I said before, were the finance director and the managing director of KWB. They are the minority interest holders of the 49%. They are the executives of that business and taking that business forwards. Certainly we understand that the natural fit of increasing our ownership of that business into our portfolio, and certainly when looking at other opportunities, if you just took this hypothetically at a 49% increase of that business versus another acquisition, clearly in terms of risk profile and return, we recognize increasing that 51% holding makes sense in that regard. It will no doubt increase the EBIT more of the business. So yes, we're very much alive to that opportunity. It absolutely makes sense. Valuation is something that's important, as well as obviously having two sets of parties that are interested in doing that. That business clearly also generates good dividend return and a good yield for the minority interests as well. So very much alive to that. Very much recognise the value it can add, but there's a lot of details around that in terms of the timing to do that. If we don't do that, then certainly we still have a great growth profile with the business and with the expanding footprint of the business in terms of only owning a 51% ownership.
Okay, next one. What's your long-term store target for KWB, and why do you think in the kitchen showroom sector there's no large national players outside of Harvey Norman?
I think the footprint potential is obviously quite significant. We're at 25 stores now, and you can see it's certainly not inconceivable that to step into WA and into Victoria and other sort of potential expansion in certain regional areas, you could sit at 50 stores and double that footprint. Why there's no other players? It's interesting. Good Guys and Freedom, try and offer this type of product, but it seems to be that it's sort of an adjunct to their business. I believe that they have a section of their sort of showrooms when you go in that are directed to this. We are purely focused on this. I'm not really sure why the larger players, don't do that. Maybe, in the overall scheme of what they do, it's just not significant enough, because it does take a lot of focus. There's a lot of customer touch points in this. There's a lot that can go wrong. We have a very solid, business model, understanding those touch points, a lot of solid processes and systems, within this that allow us to, replicate what we do at scale. And certainly, there's a lot of smaller players that do this, but just can't, step out and do this on scale, because it's just too challenging for them. So, it's just a specialization of what we do. And I think the need to do that, that is, one of the real strengths that we have.
Dan, we're just up on time. Have you got 5 minutes to tackle some of these other questions?
I do.
Okay, great. We'll keep going then. Maybe if I can just squeeze in one myself quickly. So you're saying, you can double the KWB footprint. What do you think Bedshed could also get to 50 stores nationwide? Is it, anywhere there's a KWB, I'm guessing that market would also be a potential market for a Bedshed outlet.
Absolutely, and there are some synergies. Clearly there's some synergies, with the businesses and where they're located as well. The Bedshed is in a more competitive market, and I think that it's not the product offering that is the challenges. With Bedshed growth, it's the location and the competition for the locations. It's a relatively large footprint for a store comparatively, compared to a KWB showroom, and we have a good interest in franchisees. We have a good franchisee model offering, and a great reputation. I think we took market share as well during COVID, certainly in the first half of the financial year. So yeah, look, there's certainly potential to do that, and moving into, for example, New South Wales, as we start to step into Sydney Metro, you do find that as you establish the presence, it becomes easier to grow, and that was part of having that e-store. But getting the right location and the right property is also key for this sort of competitive retail offering that Bedshed is.
Okay, two-part question here, Dan. What's your plans for the 20 million in cash, and how do you think about the unit economics and payback for each new KWB store?
So with regards to the cash, that's the group cash. So that includes the cash that's held at KWB. If you look at the KWB numbers, and you look at our numbers, there's about $10 or $11 million of deposits that are held. So they are customer deposits that are held, that are obviously held in cash. So that gives some idea of the cash balance in KWB. If you also add on, some working capital surplus on that. So, the Joyce share, therefore, of its owned share, if you like, which is the cash that we have plus 51% of the KWB cash, is not at that 20 million mark. We have a dividend target on the NPAT ratio. We will maintain the rest of the cash for growth opportunities, be they organic new opportunities that we look at, or be they potential acquisition opportunities. With regards to the economic units for the stores for KWB, the footprint, I think it's circa $300,000 to bring a store fitted out and bring a store on, and then there's a payback period when you open the store, you're obviously initially doing the retail element of the business. You're basically selling the product, getting the design appointments. So there's a time frame then before that converts into revenue, and then there's a time frame for that to sort of scale up. That can be around 12 months historically. That's been around that 12-month mark, but has actually been brought forwards with the performance in Sydney. So it's really about, therefore, the size of the market and the potential market, because we don't see the economics tailoring off once we hit our straps on those stores. And in fact, what we're seeing in Sydney is that I think the market is stronger than we thought, and whether that's people renovating their homes earlier because the property prices are so strong than what we typically have predicted and work on when we look to open a new store and locate a new store, or whether that's from the COVID lockdown and people spending money that they would spend on holidays. I'm not sure, but they are very robust performers once they're up and running.
Okay, great. Dan, I think we're going to have to leave it there because we've already run over time, and I'm conscious of everybody else's time as well. There were 1 or 2 questions we didn't get to, so Dan's email address is there. So if you want to shoot those through to Dan directly, I'm sure he will come back to you. Dan, thanks again for coming in and giving us an update on all things Joyce, and we'll keep an eye on things throughout this next financial year.
Well, thank you very much. Thank you all for listening and your time. Thank you, Mark. And can I please, encourage anyone who's got any questions to come through and ask me with the questions. I had a webinar the other day, and there were some questions asked at the end that I wasn't aware of. So I will happily answer the questions offline, directly, on the phone, by email. So please do reach out to me.
Okay, great. Thanks, Dan. And thanks to all our attendees. And I wish everyone a good rest of their Thursday.